Let's move on now to our next story on Breakfast Central. The Center for the Promotion of Private Enterprises said that Nigeria's debt, including that of the Asset Management Corporation of Nigeria and borrowings from the Central Bank of Nigeria, can hit 50 trillion naira within the shortest possible time. The Chief Executive Officer CPPE, Dr. Muda Yusuf, said this during an event to present the 2022 first quarter economic review of CPPE in Lagos.
The Debt Management Office had reported that total public debt was 39.56 trillion naira as of December of 2021. About 11.3% of this debt is owed by the state and FCT. The International Monetary Fund, IMF, says the high public debt level of Nigeria and other sub-Saharan African countries is worsening inflation in the various countries. Joining us to make clear what lays ahead for Nigeria and its citizens is business analyst and chief economics at Streetnomics. We have Gospel Ebele. Many thanks for joining the program, Gospel. We just heard it now from the story we've just read, talking about Nigeria's projected debt rise to 50 trillion naira. It's quite alarming. Now, in your own opinion, how best can this be tackled? How can we prevent this alarming debt situation from escalating? Gospel, you might need to unmute your microphone for us to hear you properly. Beautiful. Please go ahead with the answer.
Thank you so much for having me this morning. Yes, it's quite a very, very worrisome situation, to be honest. And that's because we, over the years, have not properly, used it as a tool for the strategic or productive investments required, to scale economic productivity and reinvestment back into the economy. And until you can have productivity and reinvestment back into the economy, all right, you cannot, in the future, repay back those debts early and probably, find a more better ground to scale your growth and development in the real sense of things. Debts are not really bad in the sense, even the richest of countries have larger debt portfolios, all right? But the problem is, what are you borrowing for, or how are those funds being channeled, all right? Which pipelines or which sectors drive growth faster, all right, and investments faster? And how much of these debt monies are going into those sectors? So it's a conversation of how and why and what, in the real sense of things, than is debt good and how do we secure sustainability or anything in that order in the long term, So there are fears around what's obtainable within this context, but it's really, really, really a slow. Nigeria is really, really at an emergency position, and it's really destroying, a lot of our future prospects as well financially.
That's a bit scary to hear, especially for Nigerians now, that it's destroying a lot of future prospects. But let's also look at this, that the need for loans to augment revenue is indeed a global issue that has come to stay. And like you also mentioned, debt in itself isn't bad. Now, concessional loans are being put forward over commercial loans. Can you help us and explain this? Help us break down the difference between concessional and, of course, looking at the commercial.
Yeah, so the truth is, because the rate at which the world is going in terms of complexities in achieving developmental aspirations, all right, we have a situation where debt is required for different reasons. And it actually makes sense, all right, to deploy debt as a tool for different reasons as well. We are also looking at positions where debt can be tailored specifically for issues around infrastructure financing, development financing, and the likes. All right, and there's also some form of projects that require, short-term debts as financing options, such that when those projects kick off live, you can pay back, subsequently. Like you have the Lekki toll gates. I know that was the concessionary project. Even the rail project was a concessionary in some sense, meaning that the funds are made available for a project reason. And once that project is delivered, all right, revenue from that project over time would be used to either service or pay back little by little over a long period of time and all that. And that's the conversation that, a lot of stakeholders are seeking to have now, in such that they're helping to cushion the impact of a huge debt portfolio that may not be targeted at anything. And that's the conversation. Now, that's the difference between commercial debt. Commercial debts are more tailored towards relatively generic options, and it could be raised from anywhere in the world, but you now have more targeted debt around climate bond, green financing, and all that, infrastructure financing, and all that. So nations in the world are beginning to explore both options, as a means to targeting debt into critical investment blocks that can help convert, for sustainable growth and development, and early paybacks in terms of debt servicing and repayment of debt capital. So those are the worries in this context. But in the Nigerian conversation, the context has been that those monies have not really been used in effective funding pipelines. Effective funding pipelines. Institutions are still very weak, all right, in deploying debt towards the right policy execution programs. And even the policies themselves are not effectively designed to deliver the right solution. So it's just like you're trying to fetch water with baskets, all right? So the money just get down the drain with the poorly fit policy programs in the sense of things. So, but in all fairness, for instance, the Lagos-Ibadan Rail project is largely a debt project. But then again, there are nuances to how that works. As far as the infrastructure is working, there's a prospect to getting things done better in the future. But then we need to rework the debt structure and what we are spending on. We cannot be spending 70% on paying salaries and expecting that we'll be able to, pay back our debt and get good returns from our debt in terms of economic productivity and growth going forward.
Talking about the recurrent expenditures. Now, some school of thought actually believe that after that, the AFCTA is the best solution for Nigeria and Africa's debt issue. Now, looking at knowledge transfer, cross-border trade, investment, and ease of movement, is this realistic in the next 5 to 10 years, do you think?
In all fairness, surface level conversation, the AFCFTA has a lot of, potentials. But there are a lot of structural misalignments that may frustrate, the ability for that agenda to see the light of day. So take, for instance, the idea, you mentioned about cross-border trading and all that. Different countries have different trading structures and trading process. And one of the major challenges has been this idea of comparative advantage. Some countries are stronger than some other African countries in terms of what you produce, how you produce, and how you access markets, all right? And you may have a challenge where other markets are sort of preyed or, taking advantage of other markets. And it's going to bring some form of regional inequality, in terms of market development and all that. But, if you look at it from the bright side, it has the potential as well to enable markets that may not have the capacity to thrive on their own to jump or leverage on a form of regional growth. But, there are also concerns around the unity of African leaders when it comes to enabling growth and all that. Then the AFCTA also hits on a few assumptions that the African region will come up with a unique currency of its own, all right, that will have a much more unified monetary market or monetary system. Having a unified monetary system in Africa is almost impossible because, first of all, each country in Africa has different monetary structures and monetary system. The Francophone countries still have their nuances with the colonial masters when it comes to remittances, and all of that, And then cross-border trading within the continent. A lot of times, in as much as the PAPSS, the regional payment settling system has been created, I don't think it has fully gone live yet. All right. So if I want to buy a product or ship goods from Nigeria to Kenya, I would likely have to do it in dollars. And the recipient in Kenya receives the Kenya shilling variant from the dollars conversion sense. So there's a challenge of removing the third-party currency, all right, in the exchange convertibility process between two African countries. I need to be able to send monies in Naira and somebody in Kenya receives it in Kenyan shillings. All right, that conversation is yet, to fully be, to be effective in terms of executing, for cross-border trading. So there are a lot of monetary, fiscal, and trade structures that must be in place, And the execution of the agenda must enable weaker countries to come on board. If it doesn't enable weaker countries to come on board, there will be stronger regional inequality, and that will frustrate the overall plan and the overall agenda of the AfCFTA.
All right, you know what? We'd like to go on and on and on because this breakdown is indeed what every single Nigerian should know about. And of course, like they say, even in sub-Saharan Africa. Thank you for being here with us, CEO Streetnomics, and
Thank you
don't
for
forget
having me.
to business analyst Gospel Obede. Thank you.
Thank
All
you.
right.
Have a great day.